and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, a lot of the focus, of course, has been on the markets over the last 10 days. There's been a lot going on in terms of volatility, so it's a good time to take stock and just to look at what some of the futures in the U.S. could tell us about what's happening ahead. So let's look at the markets. Look, if you look at European stocks for the moment, they're gaining a little bit. But again, the focus will be on what central banks will tell us with some inflation reports and, of course, with some jobs data as well. This is a picture for the S&P futures getting some 0.5%. The focus is firmly also on the UK because we've had a number of people coming on to talk to us about what the rate path ahead for the BOE is. So UK unemployment actually has dipped unexpectedly. This is another sign that we needed. Yet the economy seems to be holding pretty well. The jobless rate falling some 0.2 percentage points to 4.2% of the 3 months to June. That's according to the ONS. Economists had expected a smaller increase. Now, employment surged by 97,000, much stronger than the 3,000 increase that forecasters had expected, and then wage growth slowed in line with expectations. A couple of the other things we're watching out for. I just look at the week we've had. I know we're Tuesday. It feels like Monday 10 days ago was about 30 days ago just because of the dips. And so we're now seeing quite a lot of the big money players saying, look, is now the time to come in and come back into this volatility in the markets. After last week's turmoil, markets are focused, of course, on consumer price index from the U.S. That's tomorrow to see if the Fed will have a freer or more constrained hand in to secure a soft landing from the economy. Now, we also look at crude oil prices. Again, if you look at the recent rally that we've seen there, it's definitely put the spotlight on producer price numbers later on Tuesday. That's later today as an indicator of pipeline inflationary risks. So European stocks in the green this morning, tracking gains in Asia. This as investors wait for U.S. factory price data that may provide, as I was saying, guidance about the Fed's policy path ahead. So for more on all of this, let's bring in Beata Manthey, Citigroup's head of European equity strategy. Beata, as always, thank you so much for joining us. What a week. I mean, it was like a crazy 10 days.
Pleasure to be here. What a week, what a month, what a summer, right?
What have we learned? I mean, how much of it is a carry trade? Are you concerned that these type of events where actually everything, I don't know whether it's panic or there's fear gripping the markets, could happen again?
There were a few issues that coincided at the same time, right? So we've had fundamental economic reasons to worry about the economic slowdown out of the U.S. To be fair, it started already a few months ago. The market just decided to ignore it, right? And then, of course, we had Bank of Japan and lighter volumes. And here we are, 10% correction in the space of very few days. But going forward, so we have seen reasons to be worried about increased volatility already in July, right? And most of these reasons have not gone away. So going forward, of course, the market looks much more reasonably priced. We can talk about that. But these worries are still there. So the worst probably behind us, but I do worry that we could have a volatile month and autumn ahead of us as all these worries clarify and we'll know more about what's the path forward.
So, Beata, I mean, and there are a number of investors that said, look, this is the right time to buy the dip. I mean, would you recommend, I know you also have this narrative of actually 6, 7 great companies in Europe. Some of them have lost quite a lot in the last 10 days. Is now a good entry point?
So, starting from the top of the market, for Europe, we have this model that tries to capture what kind of EPS outlook the market is pricing in at each point in time. And it is important because, as we've discussed, core of the worries was about slowing down in the economy and therefore in the EPS. And indeed, we've been seeing some downgrades from the analysts happening for the last few months. So the analysts' forecasts have been at risk, right? So what this model was telling us for Europe a month ago was that the market was pricing in an outlook for EPS of around 15% growth, 5% above 10% of analyst EPS growth. Right now, it's 5%. It's not a slowdown. It's not a recession priced in. Definitely not there yet, if that's what the market decides to worry about. But we've opened up a buffer now for downgrades if indeed we are facing a bit more challenging macro ahead.
Where does that challenge come from? Again, there's concerns about the U.S. economy. Are we underestimating the impact that a lower Chinese or disappointing Chinese economy could have?
So for Europe, actually, we've had lots of positive catalysts, right? Of course, the upgrades, the improvement of balance of risk globally, the rate cuts, China reflation, and bearish positioning earlier in the year. They were all telling us buy Europe, and we were buying Europe, right? But it's just striking that all these tailwinds have turned into headwinds now. So it's not just one factor that worries me about Europe ahead. One positive, as I said, is that it's much more reasonably priced. So perhaps pricing in 5% EPS growth, half of what the analysts are expecting, could be enough in the right set of scenarios.
But was Europe already cheap before this correction?
No, it wasn't. If you look at valuations relative to the US, of course, it was cheap. But I don't like to look at the markets just from the valuation perspective. So our what's pricing model have valuations in it, but it has many other factors, and rates being also one of them. So it's rates adjusted. And I think it gives you a better feel of what kind of outlook the market is envisaging.
Beata, if you look at, again, outside kind of overseas factors, I mean, we have a big U.S. election, we have the China macro, we have a number of possible trade wars and tariffs. I mean, there's a lot of things that could actually impact Europe without Europe having much of a say.
Absolutely. So geopolitics, we have this geopolitical risk premium model that tries to capture what kind of first of all, how high these risks are, and secondly, what kind of sensitivities different equity markets have to the increase in these geopolitical risks. And within developed markets, sadly, Europe is one of the most sensitive to the downsides, right? So if you think that there are going to be higher risk through geopolitics, Trump, of course, tariffs worry me, even if there are no tariffs on the broader world, even if there are only tariffs on China. This is going to have a deflationary effect on the European economy because we'll have a substitution effect, so more imports from China that could otherwise go to the US, right? So not great outlook, not a disastrous outlook, definitely. Market has just gone ahead of the bad news now, so that's a good thing. But we are really watching every data point coming out of the US and out of China, and of course how it impacts the European economic variables as well.
But I mean, it's quite for me, it's quite surprising that we've talked about, the gravitational pull from the Fed and the U.S. and actually we're looking at one cut in September. I know the market got ahead of themselves in a possible cut before, actually this week or last week. That didn't happen. But how does a gravitational pull of the Fed, what does that mean for the ECB going forward?
That's a very good question. So the market is now pricing in more cuts out of the Fed than out of the ECB, right? That's an interesting setup, and let's see whether that's going to happen. Now, from Citi Economist's standpoint, we actually expect a bit in line with the market for the US and for Europe. We expect another 2, perhaps 3 cuts out of the ECB. So still a lot to be seen how steady the course the ECB will hold if indeed Fed, through weakening economic data in the US, is forced to do more than we thought it would be the case beforehand.
Beata, thank you so much. Beata Manthey there from Citigroup stays with us, and we'll talk a little bit more about these pockets of growth and potential tactical playing. Coming up, talking politics, Elon Musk interviews Donald Trump and pitches himself for a potential role in a Republican White House. That's next, and this is Bloomberg.
Next week, Balance of Power is live in Chicago for the Democratic National Convention.
So we've got a race here, and the sprint begins.
We'll bring you breaking developments.
Vice President Kamala Harris closing the gap with Donald Trump.
And informative analysis, all leading up to special coverage Thursday evening, including Vice President Harris's acceptance speech as the Democratic nominee for president.
As president, I will show Donald Trump what real leadership looks like.
Tune in all next week on Bloomberg Television.
The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, Elon Musk has pitched himself for a role cutting U.S. federal spending in a second Donald Trump administration. The billionaire Tesla boss spoke to the Republican presidential nominee in a 2-hour conversation on X.
I think it would be great to just have a government efficiency commission that takes a look at these things and just ensures that the taxpayer money, the taxpayers' hard-earned money, is spent in a good way. And I'd be happy to help out on such a commission.
I'd love it
if it were formed.
Well, you're the greatest cutter.
Well, our senior editor, Bill Ferries, now joins us from Singapore. Bill, I mean, it was meant to last 40 minutes. It was 2 hours long. There were quite a lot of glitches. At times, it was like Musk was pitching for a job. There was some, strangeness about the Time cover magazine. But what did we actually learn about, budget cuts and policy?
Yeah, and the two men at times were kind of talking over each other a little bit, trying to get their points across. But it was in general, a very friendly discussion. And as you played there, Elon Musk at least 2 or 3 times kind of kept raising this idea of a government commission to look at how U.S. federal money is spent. That's not such a new idea in Washington. Those things have come up over the years. But it did show his willingness to serve in some capacity in the Trump administration. If you were around for the first round in 2017 to 2021, you'll remember Elon Musk was part of a CEO panel that Trump convened in his first year. And that kind of broke apart by late 2017. Musk was one of the CEOs who quit that panel over his frustration about Trump quitting the Paris Climate Accord. But there were 4 or 5 other high-profile CEOs at the time who left within a span of a few weeks, and Trump ended up dissolving that commission. But he seems to be back in Trump's good graces and willing to work with him if he wins in November.
So who got more from this exchange, Trump or Musk?
Well, it was a rough start. It was almost 40 minutes of glitches that delayed the start of this. But, Musk did get to have Trump back on his on X now. Was Twitter the last time the president was really involved in it. So that is a win in terms of just traffic to the site. The conversation between those two peaked at 1.3 million. It also allows former President Trump to reach an audience that is many of whom are not members of his Truth Social website. That does not have nearly as many followers as X does at this point. So I think both won to some degree, although I think the technical glitches at the start are probably a bit of a headache for Musk and his team over there at X.
Yeah, didn't they say, Bill, that they were hacked or that there was some kind of nefarious, actor or actors in this? And do we know how many people listened to the conversation?
Well, you're right. He said Twitter or X has said that there was some kind of a hack. We don't have any details on that. You may remember when Governor Ron DeSantis of Florida announced his presidential run. It was done on X, and there were a lot of glitches associated with that. It took, I think, over an hour to really get going. So it's not clear if it's a hack or just some technical issues with X itself. According to the company, 1.3 million tuned in at the peak. So that would be a pretty good audience. Of course, that's kind of an international audience, so we don't know how many of those are American voters, and we don't know how many of those are American voters who are persuadable for the Trump camp in November.
Yeah, it's unclear whether Musk gets the job on the back of this is if Donald Trump gets elected. But, Bill, what did they touch on geopolitics-wise?
Yeah, they did touch on some of the hot spots, Ukraine, the Middle East. Former President Trump name-checked Vladimir Putin, Kim Jong-un. He said, and Xi Jinping, actually, he says he knows them all. He says things like this potential attack by Iran on Israel that the U.S. has been warning about. He said that would never have happened if he were in charge, that Iran was poor and weak when he was president. So he did try to touch on some of these things that he sees as a crisis in the world, and claims that none of this really would have happened on his watch.
Bill, thank you so much. Bill Ferry's there with the very latest on Musk and Trump. Plenty more to come. This is Bloomberg. The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, still with us, Beata Manthey, Citigroup's head of European equity strategy. Beata, you were basically saying that because of the rocky couple of weeks, we probably have some more realistic earnings per share outcomes. So what does it mean when you look at Europe? I mean, do you invest in certain sectors that, have had a correction, or is it really opportunities despite tariffs and trade wars?
So let's start with earnings. European earnings have been the most upgraded around the world until June, until the French election announcement happened. Since then, through all different risks emerging, it continues to be one of the most downgraded regions. And putting this together with the macroeconomic worries of at least a slowdown, right, tells me that the market should be concentrated on earnings delivery. So we like sectors where momentum is strong, where earnings continue to project higher. And for us, over the compound basis, this and next year, that's how we look at it, and also at short-term earnings momentum. So our overweights right now in Europe include tech. We continue to like healthcare. And within financials, actually, we like financial services more than banks, and this is exactly where both earnings momentum and the strength of the rebound is the most pronounced. On the downside, more cyclicals. So we've downgraded everything around July. Well, some cyclicals like autos we've had as an underweight for a few months, but we've downgraded industrials mid-July, construction, basic resources from neutral to underweight. So it is pro-growth, more skewed towards defensive growth and defensive earnings, away from very cyclical earnings outlook for now.
Beata, when you look at, I guess, some of the things that have been trying to reprice, I don't know how much of European earnings come into this. I mean, it feels like if you're disappointed, you are really slammed by the markets. And so are expectations a little bit too high on how quickly these companies can grow and put revenue up?
Absolutely. So the market sell-off was quite orderly outside of Japan, where everything has gone down, right, irrespectively of what the earnings story is. So to us, and according to Citi stock analysts as well, tech was quite a standout. So, also, first of all, from the earnings perspective and the prospects for the European tech sector, but also from the bigger macro point perspective, that if you worry about growth, you do buy into growth. You buy into these fewer parts of the market that are still providing growth.
Do you buy any do you buy any French companies, given that actually there's still a big question mark? I mean, they had fantastic Olympics, and then we go back to kind of trying to find a viable government.
Absolutely. So these political risks in Europe filter in more into the outlook more than in the US, for example, right? So with the French, the downgrades in France has started already ahead of the announcement of the election, and then just continued. It is the most downgraded country within the major European countries. So that momentum, we haven't seen a turn in that momentum yet. For us, France in the country allocation model is a neutral. We are within the big sectors in CAC 40. We are neutral industrials, and we are neutral luxury goods, and we are underweight autos.
Beata, thank you so much for a terrific roundup of some of the things that we're seeing in the markets. Beata Manthey from Citigroup. Coming up, bouncing back, UK unemployment catches a few off guard by unexpectedly dipping in the second quarter. We'll crunch the numbers next, and this is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. These are your top stories. European stocks gain as investors wait for U.S. price data that may give more guidance about the Fed's next moves. IEA data shows global oil markets are poised to swing from a deficit to a surplus next quarter should OPEC Plus proceed with plans to boost supplies. Plus, despite tech delays, Elon Musk pitches a role for himself should Donald Trump win a second term in the White House during a lengthy interview on X. Now, here in the UK, the pound rallied 0.3% after unemployment fell unexpectedly after companies went on mini hiring sprees. Now, the jobless rate fell 0.2% to 4.2% in the second quarter. Now, 97,000 new jobs were added, which was much higher than economists had forecast. So for all of the news on the UK, we're now joined by Ellie Henderson, who's an economist at Investec, and Dan Hansen from Bloomberg Economics. So again, jobless rate falling 0.2 percentage points. Ellie, when you look at, it's happy days. You know, we were kind of worried about the economy. We have the cuts, and now unemployment's a little bit stronger than expected.
Yes, it was an unexpected fall, as you said, to 4.2%. And from an individual's perspective, this is great news. As you said, the sun is shining, the unemployment rate is lower. But for the Bank of England that's worried about domestic inflationary pressures, they may be concerned by this print. But the report was mixed. We also saw a rise in the claimant count, so people claiming unemployment or unemployment-related benefits. But the ONS did note that some of that was due to changes that the government made around eligibility criteria. So I don't think we can take a clear signal from these numbers of the state of the labour market just yet.
Yeah, so what are you waiting to see, Dan, to make sure that actually it is on a path that's not just like a blip upwards, but actually a trend upwards?
In terms of the jobs market?
In terms of the jobs market.
Yeah, I think there are a few things. So the first is that the unemployment data we know is a bit sketchy. So we're going to have to see quite a bit of it to be convinced that it is a signal and not just noise. What I would sort of place it alongside is what we saw today on the vacancies data, which is continuing to fall, but it is there's a bit of a sign of a levelling off there as well. Payrolls continues to grow, but it's weak. So I think you can't yet throw out the story of a gradually loosening labour market. And as Ellie said there, we had pay growth numbers, they continue to come down, and that's a signal about the state of the labour market. But I think if you move into the second half of the year and the economy continues to hold up, we're talking about the sun being out, the UK economy has been growing 0.7% a quarter, 2.8% annualised. That is really fast. And against that backdrop, over the past 15 years, the labour market has always tightened. It's never loosened because productivity growth has been so weak. The firms have had to take on more labour to produce more output. So it's going to be interesting as we move into the second half whether this loosening labour market story continues to hold or whether actually we get a move in the other direction. And obviously that will have significant implications for what the bank is able to do in terms of rate cuts.
But Dan, first of all, there's some investors that are basically looking at these figures and saying, look, it's potentially inflationary, or it's a potentially inflationary sign on the economy. But actually, is it really just at the margins? We're also waiting for that budget, which is why, at the last press conference, Governor Bailey seemed very tentative in trying to manage expectations.
Yeah, absolutely. So, at the margin it is, but I think you have to place it, as I say, in the context of the volatility in the data. Reading it straight off, the Bank of England said a couple of weeks ago that the medium-term unemployment rates, the rate of unemployment that neither speeds up nor slows down wage growth, has risen. So we've essentially got further from that. So, yes, straight read, it is potentially a little bit more inflationary that the Bank of England were hoping. But I think if you read it through to the inflation numbers, if you're going to get, it's not going to be more than a rounding error. So I don't think we need to sort of completely throw out our priors just yet. You're right that the budget could be a much bigger event. We know there's 16 billion, at the moment at least, 16 billion pounds coming in extra borrowing this year. We found that out just before the Bank of England's decision. So the big question really will then be, over the next couple of years, how much of that is brought back in terms of tax rises and the fiscal stance over the next 3 years. Because, it's fine to have a fiscal loosening this year, but if you take it all away in subsequent years through higher taxes, that means demand in the economy is probably not much different, and therefore the inflationary pressure in the economy is not much different. So they need to see the whole picture before they can make a judgment on that.
Yeah, it's difficult, again, passing judgment before actually seeing the budget numbers, which is what, Governor Bailey said over and over and over again.
Yeah, definitely. And on the labour market report being inflationary, I think it's also worth talking about the wage numbers. Yeah. On the headline measure, the total wage growth, we did see a sharp fall there, which again, for individuals that are struggling with the cost of living, isn't great, but from an inflation perspective, is what the Bank of England wants to see. But on those total pay numbers, the headline probably overstates the story a little bit. Last year, we had big one-off bonus payments to NHS staff. This wasn't repeated this year, and that pulled down the headline number. But what the Bank of England will be looking at is private sector regular pay, which strips out the public sector, it strips out bonuses, and it has a more direct link to inflation. And that saw a moderation too, which supports the case that actually it may be appropriate to cut interest rates once more again this year, which is our base view.
So one more by what, 25 or 50?
One more 25 basis point cut in November. We think from the last meeting, it showed that there's no rush on the committee. There's still very divided thoughts. 4 members didn't want to cut in August, 5 members did. And a lot of it comes down to the fact that services inflation is still very sticky. We've got goods price disinflation doing a lot of the work at the minute. Can we rely on that going forward? Possibly not if shipping costs rise like we're seeing, or we're moving into a more protectionist world. So the Bank of England really wants to see that services number come down.
Dan, at the same time, and I know again, the Bank of England pushed back a lot against this gravitational pull on the Fed, but actually, given all the market turmoil, we were talking even about an emergency cut from the Fed last week. I mean, if the Fed were to cut a lot more than expected, or certainly if they were even to cut, as much as the markets are expecting, what does that mean for BOE?
I mean, history tells you they can disconnect. So that's, if you look at the 2 cycles, they can disconnect. I think one episode in history where you might sort of read across to today is what happened in the early 2000s. So the Fed cut aggressively because the US economy went into a relatively shallow, but it went into a recession. The Bank of England cut, essentially put in some insurance into the system. The economy didn't go into recession, but it was worried about what might happen to the UK economy, because the UK is a small open economy. What happens in the rest of the world clearly matters. So I think it's possible that the bank sort of is a little bit influenced by what's going on over at the Federal Reserve, particularly if they cut rates aggressively. But equally, inflation is, as Ellie's just said, inflation is still very, very high, particularly in the service sector, and that is a real constraint on what the bank can do. So you might get one more. If you're thinking about the path this year, investors are looking at maybe 2. I agree with Ellie, they'll probably do 1. If the Fed goes really aggressively, you may get 1 more from the bank, but I just don't think they want to set this tone of we're going meeting by meeting. I think they want to stick quarterly, use that monetary policy report press conference every time to explain their thinking. There's just no rush, because this is about normalisation. It's not about responding to a recession or whatever it might be.
And Ellie, I guess away from the Bank of England, I mean, this country needs growth. If you look at, the US with the weak US labour market, also this anemic euro area GDP growth, could the UK become the new investment destination for foreign investors?
We're certainly optimistic on the UK. We've seen renewed sentiment over the UK's outlook, and actually our GDP numbers have been relatively healthy. We have the next update for June this week that will complete the picture for Q2 as a whole, and we see another 0.7% print on the quarter. By all means, this is quite healthy. We've got some constraints on growth in June, being the junior doctors' strikes, and also we had weak retail sales print. But overall, it is a robust pace of growth and does show off the UK as possibly a place to invest.
How much can growth, I mean, what's best case scenario for growth in the UK? I know Keir Starmer in the campaign mode, probably because he was pushed, said 2.5%. I mean, that feels very optimistic. And they haven't actually, gone back to confirm that's what they're aiming for.
It does seem on the top side of estimates. By all means, it's not impossible. We've seen the AI boom. If that can translate into higher output, then it's not out of the question. But like I said, we think it's probably on the upper side, especially if we are, as Rachel Reeves has hinted, going to get tax hikes in terms of the October the 30th budget. So I think that's going to be a key event for the UK outlook.
Yeah, it certainly will. And so growth, what's Bloomberg Economics expecting?
So we think the trend rate of growth is about half what Keir Starmer sort of said at the 2.5. He said 2.5% during the election campaign. We think it's probably about half that. One thing I think is really interesting is that the OBR, I would argue, has a relatively optimistic outlook for growth over the next 5 years. And so the risks there, I think, in terms of the fiscal picture, so the OBR is the UK fiscal watchdog, thinking about the fiscal picture and how much of a benefit sort of the growth we've seen over the past 2 quarters will translate into a higher level of output permanently and a higher level of tax receipts permanently. I think the risks are that they've deemed that as sort of a cyclical one-off, and they're going to take a look at their views about productivity growth, because to me it looks a little bit optimistic given what we've seen over past history. And I think the risk for Rachel Reeves is that the OBR hands her some bad news on the economy as well in terms of the medium-term growth outlook. So they've had this sort of sugar rush, this honeymoon, or whatever phrase you want to use. But I think the medium-term picture still needs a lot of, is still relatively sort of benign.
All right, thank you both for joining us. That was Ellie Henderson from Investec and Dan Henson from Bloomberg Economics. Coming up, the U.S. warns Iran could attack Israel as soon as this week as it deploys more firepower to the region. We get the latest next, and this is Bloomberg. The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, the U.S. believes an Iranian attack against Israel has grown even more likely and may come as soon as this week. That's according to officials. This comes as the West seeks to stop an all-out war. Now, for more, let's bring in Ross Matheson, Bloomberg's EMEA news director. Ross, so we're waiting for this possible Iranian attack, and that's continuing. I mean, we've been alerted for the last 10 days as to something happening. Is the intelligence now pointing to something bigger or just imminent?
It's interesting because, as you say, we're almost 2 weeks after the death of this senior Hamas official in Tehran, which Iran blames on Israel. I mean, Israel's never formally accepted responsibility, and Iran's been saying every day since then, we are going to do something. We have to retaliate because this happened, embarrassingly for Iran on its own soil. And they've been saying it, nothing's been happening. So people are starting to wonder what conversations are going on inside Tehran about this. What the US is saying publicly is their intelligence, obviously, is pointing towards something still coming from Iran. There is the intention there, obviously, to retaliate. What we don't know is what that's going to look like. I mean, the US said it could come in multiple forms. It could be a direct strike by Iran on Israel. And again, what kind of targets? Military targets, infrastructure, unclear what we're talking about. Is that accompanied by actions by Iran's proxies in the region, Hamas, Hezbollah and others? Is it simply the proxies do something? It's still very unclear what the nature of the retaliation might be. But the US is saying very publicly, at least what their intelligence is picking up, is that something is coming and soon.
Roz, I mean, of course, it's a very delicate time because then it means that this could escalate quite quickly. Is the U.S. also putting more firepower in the region?
Well, they are. So they're expediting the movement of a carrier group. This is the Abraham Lincoln and a strike group. It was already going to the region, and what they're doing is telling it to get there faster. They also took the kind of unusual step of announcing that they're sending a submarine to the area that can carry Tomahawk missiles, more than 100 of them. They usually don't publicise the movements of their submarines, and what they're doing in saying that is they're telling the world, including Israel, to keep their jets cool in all of this. They do not want this spiralling into a broader conflict, but also sending the message to Iran that they're there to help Israel defend itself. And they're putting their military firepower in the region to do so. So, publicising the movements very clearly to send that message to the region that they don't want a broader war, that they're there to defend Israel if needed. But also just the reality of having so many military assets in the region does in itself potentially raise the risk.
But, Raza, again, do we understand, Iran's intent? Do they want an escalation, or domestically, do they just need to be seen as doing something?
Very much they need to be seen to be doing something. It's interesting, almost every time an Iranian official has said, we need to retaliate, we will retaliate, there comes a but after that, which is, we're going to act within the bounds of international law, whatever that means, but we don't want this to escalate into a broader conflict. So there's always we need to do something, however, we also don't want this to spiral. So it's very much twin language we're getting from Iran, and it's very clear they see, for their own interests, they don't want a broader war either.
Yeah, and of course this complicates things with, a possible deal with the hostages. What about Russia? Russia and Ukraine, which is the other kind of like hotspot we're watching here.
Well, it's fascinating to see that Ukraine has made this incursion into Russia, and they've actually moved into quite a bit of territory along that border area, and it's very embarrassing for the Russian President, Vladimir Putin, to have this happening. Yesterday, in fact, he cut off the regional governor who was talking on TV detailing the number of towns that Ukraine had taken, and Putin kind of cut him off mid-speech. Obviously, he's having to manage that situation at home. The real question is, what is Ukraine intending with this? What's it about? What's the tactic here? Is it simply to show that they can do something on Russian soil, is to send that message to Vladimir Putin? Is it to form a buffer around their border area to stop, masses of Russian troops still coming in? Is it for some other reason that we're not sure about? It's very unclear what the intention is here, and that might tell us where the war is going as a result. I mean, it's tactically very bold of Ukraine to do this. They're also, though, possibly burning through manpower themselves with this incursion. They're stretching their defensive line into an offensive line also. So they're also suffering some losses here. And can they sustain it? The question is, how long are they intending to do this for?
So interesting, Roz, with always the good questions. Roz Matheson there, Bloomberg's EMEA news director. Coming up, Elon Musk has a message for Trump supporters who are skeptical about EVs. We'll have the details next. And this is Bloomberg.
Season is here.
You're seeing back-to-back billion-dollar-plus quarters.
The forward indicators were so positive.
Bloomberg is first to break the numbers.
Texas Instruments out, folks. Goldman Sachs.
Taking a look at Mattel.
There is something for everybody.
With the smartest insights.
People are whitewashing AI.
Wallets are under pressure.
We are committed to EVs. They're going to happen.
Earnings season in full swing.
We will have full and instant analysis.
Continuing coverage on Bloomberg. Context changes everything.
So Elon Musk is encouraging Donald Trump supporters to embrace EVs and sustainable energy. Now, the Tesla founder made the comments during a long conversation with the Republican presidential nominee last night. Craig Trudell, Bloomberg's global automotive editor, or we like to call him our card czar, is here, and he joins us now. I mean, it was a fascinating conversation. It was meant to be 40 minutes. It went 2 hours long. I mean, I'm not sure what they each wanted from each other, whether Elon Musk just wanted to sell EVs or pitch for a job or just give them a platform.
He did both of those things, and maybe it is sort of in all of the above. I think he also very clearly wants Trump back in the White House. I think he has long been a believer that government should get out of the way, except, of course, when it is offering help to companies, and he wants in on that help. So, he did absolutely pitch this idea of sort of a commission on things to get rid of, and, offered, to play a role in the setting up of that. And I think that's where his pitch came from. But also he was in sales mode with electric vehicles and wanting to kind of speak to Trump supporters and Trump fans of, a case for, you can have your electric vehicle and eat your steak too. Came prepared with a pitch for buying electric vehicles without, necessarily doing so on environmental merits.
But so how tough is that? Because it feels like the culture wars are real. It's a divided society, and there's many question marks about EVs and climate change. It's almost like if you're a Republican, you can't really be for those.
I think it's fascinating because Trump himself has been, one of the loudest voices, speaking to this idea of, electric vehicles, they're okay, I guess, but, you have to plug them in. They run out of battery. They're just not any good. And lately he's offered a little bit of praise with Tesla mixed in with that, but he hasn't really strayed from that messaging. So, maybe Musk is trying to sort of bend that those talking points a little bit and get Trump off of that messaging and towards something more productive for Tesla.
Okay, Craig, thank you so much. We have to get you back on also to talk about Elon Musk and the UK and the riots, which was another story. Craig Trudell, our global automotive editor. Now, global oil markets are also poised to swing from a deficit to a surplus next quarter should OPEC Plus proceed with plans to boost supplies. Well, that's according to IEA data. Let's discuss with Bloomberg's Al Nightingale. Al, thank you for joining us. So we have this report. It came out. What did it tell us about supply and demand issues in the global oil markets?
Well, it's as you said, there was this kind of proposal to
add a little bit of supply, which people took as a sign that maybe, I guess, OPEC was, the end of these kind of supply moves had to come, and that they would have to start to add barrels back to the market. And it shows that that's still a tough thing to do. So we just need to see how this plays out. But I think it will be pretty tough for OPEC to do this, and the IEA is making that clear today.
But at the same time, I mean, unusually, right, this growing demand in developed economies, such as the U.S., which is growing stronger, has really been compensated, for example, for slackness in China and other emerging nations. So is there almost a natural hedge at the moment?
Well, I mean, I think when you have concerns about China in the oil market, it's very hard to do anything in the way of adding supply. China has become the engine of demand growth for many, many years. And when you've got those kinds of worries, you really do need to see some kind of strength there and have some confidence that things are going to be okay in China if you want to start adding barrels. At the same time, within OPEC, there is this kind of requirement to think about how you're going to get out of keeping barrels off the market. The US is going from strength to strength in supply and taking share of the supply picture. So that's something that's going to be kind of a constant watch for OPEC Plus.
Yeah, I was going to ask you, what are you expecting from OPEC Plus?
Well, I think that, as the IEA is acknowledging today, it's going to be hard for them to add supply to the market. And I think that it will be tough for them to do that unless you start to see a better price picture going into the fourth quarter. So, it's just going to be a tough ask to add supply back.
Al, thanks so much. Alaric Nightingale, there, Bloomberg's Europe oil markets editor. Now, a couple of things that we're watching out for, of course, is some of the data, not only in the U.S., but we have European data a little bit later on. When you look at some of the biggest things in terms of that data, let's get the U.S. futures up. If we have those, it'd be great to show them just to give you a sense of where we are right now. Again, Wednesday's U.S. Consumer Price Index will be the big one that may help determine whether the Fed has room to secure a soft landing for the economy. Up next, Bloomberg Brief with Manus Cranny in New York, and this is Bloomberg.